The broadcast is now starting. All attendees are in listen-only mode.
Good evening, ladies and gentlemen. Welcome to the webinar. We're just a few minutes late, for which I apologize. I do welcome you all. It's good morning to our friends in Australia. Good evening to most of you in the US. Good afternoon to Sage and Graham and the rest of the team in New Zealand, and some ungodly hour of the morning in Europe and UK. So those of you who've made the effort to get up, it's great to have you here. We're going to do a little bit of tradecraft today. I want to show you a couple of trading tricks that are going to add value to your trading. And then we're going to review these major markets. Of course, gold in a most fascinating position now, with all the gold bulls, I know, salivating over the thought that that might be the low, if there is such a thing. We need to have a look where these U.S. equity markets are and the challenges they're now facing, because once again they're at a pretty critical juncture. So I think we've got everything going. Sound is good. Recording's going. You can all hear me all right? Well, that's terrific. Well, welcome to you all. Let's move on then, and let me show you my normal compliance statement, which I'm required by law to show you. You should take all of this compliance seriously, those of you who are new to trading. There's lots of things that can go wrong, and you need to know about them all, and at all times be cautious. This first chart I'm showing you is about to change. Here it is. You can see it now. This is the gold chart, and I wanted to show you how much money you can make if you put all of these Danielcode signals together. I know that most of you, the vast majority in fact, only trade the TO3 signals, but I want to show you, for those who want to do more, how well you can do by putting together all of the signals and most of the tools that we offer at the Danielcode. We had at the bottom of the chart, you can see, a blue line and a TO3 buy signal on the big up bar, which was pretty obvious for us because it had found the Danielcode number, and the stochastics were oversold, and there was divergence on the CCI, our proprietary momentum indicator. So I posted a blue line signal for that buy, and also it was also a TO3 signal. Just running down from the top though, you can see, once I grab my spotlight, how all of these combined. From this bar back here, we had a blue line and a TO3 signal, which was elected. We got 1, 2, 3, 4 days down, and then we had a buy signal in here, this bar that I'm on now. And we made about $1,300 per one contract on that sell signal. We had 1 day up on the buy signal, which was immediately followed by a plus sell signal. We lost $616 on the 1 bar counter trend trade, which, you know, had you muttering under your breath and growling. But this is what markets do all the time, and those of you who stuck with the program, there was the plus sell signal. I've talked about that before, that any of these buy signals are followed immediately by a sell signal, and vice versa, because we're assuming that there might be a trend in place. And even though at that stage we certainly didn't have any evidence to support an idea that there was a trend in place, we want to position ourselves so that if there is a trend in place, we can take advantage of it, as you can see, because there's just a whole lot of money involved, and that's what we're in. We're not in the business of being right, we're in the business of making money. gauche as that may sound, that's how we as traders measure our success. So there was your one day up, immediately followed by a sell signal, was also a plus sell signal. And then we had this run down here, 1, 2, 3, 4. Little up bar was not elected because this was an inside bar. And then one more down and your inside bar, this started setting up for the blue line trade. And that trade down there, depending where you executed the buy signal, was worth some part of $7,300. Then we got to our blue line buy signal, that's here. Now, I've told you before that when executing on inside bars that our normal protocol is we execute on the last bar that is not itself an inside bar, which means that you'd be buying somewhere up here, because this is the last bar here that was not an inside bar. So you didn't make a lot of money out of that move. And I've also said to you that sometimes you've just got to pin your ears back and go for it. When you have a big setup bar like this, the risk of buying up here with a stop that's now gone past this low, which is originally where your stop loss went, because this bar went down and gave you a false break. You got everybody short and everybody wrong, and that's why you got such a terrific bar up. But then, as well as that, if you will really want to expand your trading a bit, you'd be getting some frac-Zen signals, which is our short-term trading system, on these markets that you selected. And the frac-Zen signal came at 1147.8, and I actually put a post up on the news page you can have a look at the Danielcode website. Told you exactly the time that text signal was sent out. And if you got in by putting everything together, if you had a blue line and a TO3, you had buy signals setting up, and you then use the frac-Zen text to execute those signals earlier than you would normally, you can see the results of that trade alone, $3,160. Now, let's have a look at the headlines up here. This came from anyone else having problems with the audio? No, Raina. Somebody wants to type to Raina. Audio's fine. Sage is monitoring it, says it's great. You can see this comment was that this particular big outside bar there that we bought was the best day for gold since September 2013. And following a heavy volume flush and reversal around midnight ET, gold prices surged today. The 3.3 rally is the best day since September 2013 and the best day in 14 months. Now, when you get a monster trade like that, get out at the close. Those trades almost always require some time to consolidate, which is exactly what has happened here. So you can see that they took out the lows here, and that got all the stops on the downside, turned around and revved it up, and this little high here was their target, because that's where all the stops were on the short trades, all the unlucky stops anyway. The amateur stops were there, and that's why they went up and hit them and collected all those stops. Now, once that's happened, largely the momentum goes out of the market, and it needs some time to consolidate. So when you get those gifts, you get those great big trades like that, remember it's always wise to exit at the close. Just let me type a note to Raina, who's having trouble here. Just bear with me. Raina, okay. So we can do that. And he should be able to see that answer. Okay. Don't forget, any of you that do have problems with audio and stuff while we're transmitting, we're an awful long way away, and technology, as we know, is very much, excuse me, less than perfect. So we do record all these webinars, and by and large, we capture them, and we try to get them posted for you as soon as we can. Audio is good. Thank you, Deepak. Nice to see you here, mate. So this is just the point I'm trying to make to you, is for those of you who want to do more with your trading. There was $11,200 odd just from these recent gold trades. That's a lot of money for one contract. And you can see how putting together all of the signals and utilizing FractSend to get in early when you have the right setups can be an extremely profitable business. Okay, let's see what we've got here. Now, here's something new I want to talk to you about. Yes, perhaps I should say a word about that. Ryan is saying the problems he's having with this new format. Two issues on technology. One is that Citrix, which is the company that owns GoToWebinar, have kindly or unkindly migrated us across to their new platform. It makes the registration format so much easier, but it's got a few problems with it. One is that organizers like me don't get an email giving you a direct link to start the webinar, but more importantly, in the new platform, the link show in my time zone does not work. So when you go to register, there's a little blue line. In my view, they could make it a lot stronger, saying show in my time zone. And you can just click on that, get a drop-down menu. Shows you all the various places in the world, and if you set that to your location, your invitation and your reminder emails will all come out with the correct time if you happen to be in the US. Unfortunately, internationally, they haven't tested it enough, and it doesn't do it. It certainly didn't do it for me. I know Graham Johnson in New Zealand had a problem with it as well. The short-term fix is when you get your confirming email saying you have registered, you'll see a link in there saying show in my calendar. And if you click on that, it will put the calendar note in your calendar, whether it's the Google Calendar or the Outlook Calendar, whatever, which will show the correct local time for you. So that's the short-term fix, which is fine, unless you're like Sage and me, in which case we have our computers running on US time anyway, so it doesn't really help us. There we are. Yes, I'll try and do that if I've got time. Okay, so a couple of ideas for you here to increase your trading opportunities and your profitability. And what we're looking here is this is Euro JPY. And this little outside bar back here in early November, I've got the highlighter underneath it. That actually set up a sell signal. It was a blue line and a TO3 sell signal. Now, with these signals, only about 50% of them are actually elected, maybe 55, 56%. So there's a large percentage of them that are not elected. But the point is that, and to be elected, for those of you who are not familiar with our terminology, for a sell signal would have to trade 2 ticks below the setup bar's low, and vice versa on a buy. But this was a sell signal that didn't get elected. Now, what happens with these signals is that when they get to the stage that they've created either a blue line trade or a TO3 trade, it implies that time and price have been reached where a turn is a high probability event. And if supply and demand remain balanced, or at least in the same proportion that they have been, then that turn will eventuate. However, what happens sometimes, and often enough to you to take advantage of it, is that a new force comes into the market, and that new force pushes the market in its original direction, and that's exactly what happened here. So you have to put on your orders anyway. For the sell side here, you put on your sell order at 137, which was the setup bar's low minus 2 ticks, and you put on your stop loss, an if done stop loss, at 138.11 as your protective stop. Now it's quite simple. Instead of making one the entry and one the stop, it's quite simple to make them both active orders. So you could, instead of having a stop loss at 138.11, you could simply have a buy at market at 138.11 or a buy on stop, and a sell-on stop at 137, which means whichever way the market went, you're going to get elected. And on these occasions, don't do this every day, it doesn't work, but it does work when you have the setup. That is either a blue line signal or a TO3 signal. If those signals are not elected, it means that an additional force has come into the market in the direction of the previous trend, and that's why we get big bars like this. I mean, this is the biggest bar on the chart for quite a considerable period of time. Excuse me, for a considerable period of time, and that's why these happen, because an additional extra force has come into the market that drives the market in its original direction, and that's very profitable. Now, if you adopt that or think about that as part of your strategy, you'll find that you make a whole lot more money out of it. The next point I want to get to up here that we haven't talked about, with our stops, when we're trying to stay in a trade, we usually use the fast stochastic. This has got the slow stochastic on it, the 1433, but we use the 533, the fast stochastic, and we use a 2-bar trailing stop until the stochastic gets overbought or oversold, at which stage we move to a 1-bar trailing stop. You can, if you wish to try something different, use what's called a time stop, and that is you can allow a counter trend of 1, 2, or 3 bars if you so wish, and that will avoid these nasty little 1-bar counter trends here. If you decide to do that, I suggest that you have a catastrophe stop anyway, because you don't actually know that 1-bar counter trend is only going to be a small bar. It might be a turn and you get a massive bar down. So you do need to have a stop somewhere to protect your profits a bit, but you can use a time stop. 1 bar is quite common, 2 bars not so common, and using a 3-bar time stop is very aggressive. But that's an option for you. I know a lot of people who do it. For those of you who want to stay in trades longer, that's the best solution, because it is inevitable, almost certainly, that markets will fluctuate as they make their trend run. You'll have 1 or more bars down. So that's certainly a technique for you to think about. And that will give you, of course, about probably another 40% of entries that you're not getting now, and they do tend to be bigger than average trades, because the mechanism that creates them is a increase in the balance of the supply and demand equation. So that's why you get these big bars. Okay, so that's certainly worth looking at and thinking about. And of course, don't forget these blue line targets up here. They are targets. If you're looking for somewhere to get out, if you put your exits, your stops here to exit, you'll find that nearly always you'll get some positive slippage. That may not be the end of the move, incidentally. Those of you who've got this Euro JPY chart in front of you will see that we had a fairly bullish inside bar today, and this may well go up to 1, 2, 3, or 4, or even more blue line levels as we go, but you'll be able to see those from the charts. But if you do want to take profits, if you put your exit here, it'll be a sell on stop. You're very likely to get positive slippage, which is very nice. Little fish are sweet. Okay, here's the last little point I want to make to you about some tradecraft. This is a chart of natural gas. A lot of these markets are rolling over on Monday or Tuesday, and I haven't put signals up for them because I try not to put up signals when you're going into a rollover period. This logo down here, you can't see it. I've obscured it now with my spotlight, but I'll move that to one side, and you can see it's a squiggly thing in there, depending on how good your eyes are, which is a function largely of how young you are. Ben, you shouting at me with big block letters there. Excuse me, I know you're a young buck. You can see it really clearly. That's the letter R inside a diamond, and that's Trade Navigator's way of telling you that that's the anticipated date for the contract rollover based on past performance. So you need to find that. You'll see it on all of your 057 charts, and you need to be aware of that so you know when rollover is coming. Now, rollover doesn't mean you have to be out of the contract on that date. These markets will trade for 5, 6, 10, sometimes more days after rollover, but you have to make sure that you know what the last trading day is and you're out of the market well before that. But what happens once the contract has rolled to the new contract is your broker will not let you open a new contract in that old the old expiring contract. But there's no need to panic about getting out just exactly on the rollover day. You've got a reasonable period of time, quite a number of days after that, if you're in a good trade and want to stick with it. However, contract rollovers are the highest probability for a trend reversal. So as you get into that sort of time area, you need to be alert. What I want to show you here was this gap where I put the spotlight now. You should be able to see that. And there's a gap between the high of this bar and the low of the previous bar. And I've got a iridescent green highlight bar on there because it's a color I can see quite easily. And I want to be aware of that because gaps are prime targets. Markets actually hate gaps, and they'll do everything they can to go back and fill the gap. And they're sometimes called hanging gaps. Sometimes they'll stay on the charts for very, very long periods of time, but they will get filled. In the more immediate time frame, markets do try to fill their gaps, which is one of the reasons you get this sort of zigzag pattern in markets. So here's our natural gas running up here into the high. We had a blue line sell and a TO3 sell that expired the day before it was elected. Now remember that the computer that runs all of this stuff, it does exactly what it's told to do, and it will count the blue line for 3 days and the TO3 for 2 days and carry those forward in your trade program, your Danielcode trade program. But sometimes it's one more day. And I've said before that it's worth writing down these signals and being aware that they may come a day outside our scheduled allowable times. So it's worth being aware of that. GMAG traders, you guys didn't affect you, Marcel and Co., because you had a separate GMAG sell that got you in here at 428. 1, 2, 3 bars down today. Look where it went to, right into this gap. It hasn't quite filled that gap, but it certainly will tonight. And that trade for absolutely no work and little panic or worry was worth $3,000 per one contract. So having a rough idea where that market's going to go in the short term, the first thing it's going to do is go and fill that gap. So that was pretty much a no-brainer if you were aware of it. So remember that gaps are targets. Okay, so there's something there. Here's what you need to do if you're interested in having a free trial of anything that we have here at the Danielcode. This is the procedure. You just click on the link on our web page, get a username, and Terry will be happy to give you a free trial of everything we have. We've got a pretty simple and no doubt primitive view to marketing, and that is that we don't do any, but we'd like you to have a look at our products and try them, see if they suit you. It's no good me telling you if something's great or not great, because the whole thing about trading is it must suit you, and what suits one person may not suit someone else. So have a trial, have a free trial. It doesn't cost you anything, no obligation. And then you can see which of our programs is going to work best for you, which is important. Okay, let's get out of here. I need a different tool. We can do that, and we can close that. Okay. The other point I wanted to mention about technology difficulties, apart from GoToWebinar, was the problems we've been having with our trade program in the last 48 hours. And Brian, thank you for alerting me. I'm sorry I didn't pick it up the first time you mention it, I thought you were implying I'd put in a buy instead of a sell, or vice versa. But in fact, what you were trying to tell me is the entry numbers were wrong. Now, how that's happened is on Wednesday, Trade Navigator's end-of-day data was wrong, and they subsequently corrected it, and there was a delay in getting it sent out, but when it was sent, it was corrected. However, the initial send was wrong. And with us, our data from Trade Navigator comes via a computer program that picks it up from their server and sends it to our server at the Danielcode.com, the website. And this is all done inside the website. Well, even though they corrected the data and resent it to all of you retail guys, nobody there knew about the computer that was picking up the data for the Danielcode, on which it creates its signals and runs its trade program. So that error actually came in on Wednesday, and we didn't pick it up until Thursday, and we had quite a battle getting it done right for you today, which is your Thursday. Don't worry about me talking about today. It's actually Friday down here, down under in Australia. It's Friday morning here. We're quite a few hours ahead of you, but we managed to get it fixed for Thursday after a bit of fiddling, quite a lot of it, and we've still got an error in there which you haven't seen, and you don't need to worry about it. It's not displaying in the trade program, but we've cleared out the database and got completely new downloads, and we expect that this will all be back to normal, no drama operating by Monday, which is what we like. Okay, let's move on here. Let's have a quick look. Let's start with our equity markets. We've got to find out where we are and what's happening with equities and gold. So let's start first of all with equities, because I've got this chart open. And here is the, we should always start with our very long-term chart. And this is our 24-day chart. Each of these bars on this chart represents 24 trading days. Now, you can see that we had a correction which took us from our upper areas in through here where it was having all the battles with these fourth and fifth seal lines, and that forced it down into a correction which went down to not quite one standard deviation, and has since turned around and bounced straight back up. The last time you saw this chart, it had a 59 signal, it's a Danielcode time cycle, expiring on the previous bar. And that's because it came off this bar here where I have the spotlight now. To start these time counts, you can start them from either a chart bar high-low that's more than one standard deviation from the mean, or you can start it from the closing high and closing low, and you can see the difference. Where the highlight bar now is that for that next low, remember these are done weeks after these highs and lows were established. That low was certainly, that's the major low, that's the excuse me, March 2009 crash low. You had the option of starting it either on the bar that gave you the low, which is this bar here, or on the bar that gave you the closing low, which is this previous bar right here, and both are valid. So previously we've been running this time cycle off the bar I'm showing you now, and what I've done to update it is move it to the bar that's given you the chart low rather than the closing low. So once again we have a Danielcode 59 signal sitting right on top of this chart. Now, this is not the crash cycle. The crash cycle runs high to high on the first hop. That's 59 high to high. We don't have that here. This is a cycle running on this chart at least from the low to the high, but it still is a valid Danielcode 59 cycle, and you can see from the chart that this market is attempting to it's already regained the medium. It's trying to get up to one standard deviation above the mean, which Newton's law tells us every action has an equal and opposite reaction. That applies to trading all the time. But it is now facing overhead resistance from these red lines, which are fourth and fifth seal lines, that have stopped it in the past. So it has to, if it's going up, it needs to overcome that resistance, and it also has a Danielcode time cycle expiring. So on this chart at least, this market is quite vulnerable. If you'd like to get more information on this stuff, folks, don't forget you don't have to wait for my webinars. You can go and take a look at our fourth seal product, which covers a number of popular markets: gold, S&P, DAX, copper, DX, quite a few markets. That'll give you a weekly update together with where the support and resistance is and when the time turns are going to take effect. So on our 24-day chart, we can still say that these equities are by no means out of the market. They're still facing resistance here, and they also have an expiring time cycle, which in the past has been pretty powerful. Let's move on and now look at the 12-day chart. This is a different period of chart, and you can see, let's just get you to see a bit more here, that we've got a very similar situation. Here was our correction that we said we would have. We wrote about that all the way back in July, actually, and then followed it up. The four seal followed that up with 4 separate alerts to make sure you understood what was going to happen. It did, and on this time cycle, this chart here, you've got to dive down from the 4 seal line all the way down to the median here, and then we gave you the buy signal. It's since rallied back up. Now it's overcome the resistance of these 2 red lines in here, and it's now facing this major red line up here, and it can do 2 things. It can either acknowledge that red line, in which case it'll just continue to run up it. I think I told you back in about March or April that if this market stayed in its trend and inside its Danielcode trading channel, it would be at 2100 by December. Well, it's not far away, is it? We're at 2039, so less than 70 points now to get to 2100. Mind you, it looks like it's a bit higher than that now. That was a long time ago, and these Danielcode trading channels do themselves change shape as the market moves along, so we can update that target, but it can run up. It can run along that red line, which would it would have to do a little bit more than that, because that would only get you to, there's getting towards the end of December there, maybe one more period here. That's the end of the year, and that red line's at 2079. So that's one thing it can do. The other thing it can do is be rejected by that line and turn around, and that'll be much more interesting if it does that. Here's a 6-day chart. You're just seeing the same thing, running up along the median, correction 1, 2.5 periods down. That would imply that it will try to get to 2.5 periods up here. Let's look at the index. That's the futures chart. Here's the index, which I think you have all of this information already from the other charts, and this is just showing you in more detail that it's broken through its red line here. It's got to overcome some other ones that are up there. So at the moment in equities, the trend is up. It's looking suspiciously toppy. It's also looking like it's lost a fair bit of drive, and just bear in mind this picture here, that you're facing 2 levels of resistance, where it is now and higher up at about 2100, and you're facing a 59 time cycle. So you could get a correction here next week, but the market's made enough of a correction down to the 1 standard deviation to validate its move up. So I just followed the Danielcode trade signals, and that will keep you well in place. Let's have a look here at gold. This is the biggie that a lot of you have been very interested in, particularly because of that big outside bar and the news that gold has been attaching. Working through, let's start with our 24-day chart. Here it is, and it's running down this Danielcode trading channel, which is quite normal. It's found a Danielcode red line support on a major scale, 1147, and essentially after the big 1 day up, it's just been sitting there for the rest of this week. Is that enough to tell us that the low is imminent? Well, there is a 62 signal there as well, which should, you can see it's here in black. It should actually be in blue. That is the support signal. Normally 62 cycles give us support, so let's change that so it's the right color. And we're in that area right now, which will, in fact, because this is a long-term chart, will run till the 4th of December. So there we have support, we have a time cycle, we have a known Danielcode number. We don't have anything more than that on this particular chart. So let's now move and have a look at our 12-day chart as we hone in to get a bit more of a feel for this thing. And here we are. This is your 12-day chart. You're seeing the same thing. The market's run all the way down through this trading channel, broke below it here, rallied to the median, went back to the lower channel, made a higher low, rallied, tried to hold the median, couldn't, failed, and now it's fallen down here. It hasn't reached the bottom of the trading channel, which is way down here at 1032, but it has got the same 62 time cycle. Now this is 62 lots of 2 weeks, because on our 12-day chart, each of these bars are 12 trading days, which is a little more than 2 weeks. We do have a 4th seal line across there. That's actually a 5th seal line at which it found support. Is it persuasive? Mildly so. I wouldn't make it much harder than that. There's some evidence to support that it could be a low. Is it going to be the definitive low? Nobody can tell you that. The fact is that we do not have foreknowledge of what's going to happen in the future. But what we do have is we have some very good technical tools. Let's go to the 6-day chart here. We have some incredibly good 6-day, some incredibly good tools from the Danielcode that have been proven over many, many years. Most of you have seen this stuff working again and again and again, and that gives you some degree of faith to know what's happening. So we've charted all these ups and downs here. I've taken a few of the red lines off that are no longer in evidence. And this was the, let me get my spotlight so you can see it. This was the dominant support line coming through here, this upper one of these two. And we got a really nice recognition of it there, and that really let us think that this was going to hold. And don't forget, we had a 44 cycle back there as well. And that was because you can see where this cycle starts from this high here. Previously, we had the 44 cycle running from that low there, both of which are valid. So we've just moved it along 2 periods, and we now have a 44 cycle expiring at the low last week. We have a 62 cycle right underneath it, which is our support cycle. We have support at a 4th seal line that we know is valid, and we have a false break of the Danielcode blue line at 1137.4. This market punched through there and immediately reversed, and that's called a false break. And it's an old adage of trading that fast moves come from false breaks. So that's why on the daily chart we got a fast move there on our TO3 and blue line buy signal, which we've already discussed. So there is a lot of evidence to suggest that this is probably going to be a substantial low. Now, for those of you gold bugs who write to me and say, is this the final low? The answer is we do not know, and nobody knows. Those people who attempt to tell you that they can tell when there's a final high or final low are just pulling your leg. They don't know, and people who write and talk that way are simply displaying their ignorance. The best that we can say is we have substantial evidence to support this being an important low, and only price confirmation now can tell us how important this low is going to be, if indeed it's going to be important at all. And the first target is going to be this high here. So let me get another tool, and on this chart here we're looking there's the old high there, which is at 1255.6. and that will be the first target for this move up. If it's going to move up, it's got to take out that high. Once it does that, it'll start to get more persuasive, and when we have some additional bars on, we'll be able to see where it's going, because we'll get a whole rash of new fourth and fifth seal lines which will direct us there. So in summary, on gold, yes, we have substantial evidence that this is an important low. We have two time cycles. We have 44, which is the specific time cycle for gold, sitting at the low. We also have 62 at the same time period, which is generally our support cycle that gives us support and lows. And we have price recognition at a Danielcode 4 seal line and a false break of the blue line at 1137. So there's a lot of evidence there. You can see this next bar that we're on now right here. You can see that it immediately went and sat on the red line, which is a Danielcode retracement at 1147, which just gives you further proof that the Danielcode's running the show on this market like it does on every market. Now, you should have these tools. You should have this logo over here, this icon. This little prickly fella's actually called Dan the Hedgehog, and that's part of the Danielcode library at Trade Navigator, together with the one below it, which look like Dan's behind bars, but he's not. That's actually the Danielcode time cycle tool that creates a lot of these time cycles for us. Excuse me. And if you don't have that and you remember, it's available to you free. Just shoot Terry an email at support@thedanielcode.com. Excuse me, and he will be happy to get that switched on for you. It's very good. You can get all the retracements, put them on your own charts, get the time cycles, everything else. Okay, so I think that was the important stuff I wanted to tell you. I said we'd also have a look at DX, which is we got a bit of interest in the last time we looked at it. Let's start at our major trend chart, which is our 24-day chart. We'll see what that's got to tell us. We always start with the longest period chart. It does you people good to look at this, because we're all guilty of the fact that we don't look at long-term charts often enough. So basically this market has been in a consolidation pattern going within the range set up all the way back to March 2009. And frankly, if you're an American, it's pretty pathetic. Let me show you. And this is not the all-time high by any means. That is way, way, way above this. As you can see, the chart, this chart runs out in 1985, but it used to be very considerably higher. And just even on this chart, you can see these ranges here running from about 98 up to 121. And what you've got here, this market's forced down into October 2007, and since then it's simply been going sideways within the trading range. Now, that's your spending power that's gone, guys. If you happen to be an American and use American money, that's your spending power that's been gone. That's the opposite of inflation. When you talk about inflation, the real way to measure inflation is not the increase in the price index, which is totally phony and manipulated because they exclude all the volatile issues, things that, just ask your wife, or if you're a lady who does the shopping, you don't have to be told about inflation, because everything is ridiculously expensive, and no more stupid anywhere in the world than Australia, where prices and wages and house prices are absolutely extraordinary, and a whole lot of people are going to get a large kick in the head in the not too distant future when they realize that not all is gold that glitters. But anyway, basically what this chart's showing you is you've been at 87 from 120. You've lost about 40% of your purchasing power, and that's actually the net effect of inflation. So the governments always try to keep inflation going, because what it really does is it devalues your purchasing power. You're the consumer taking the hit. Don't assume anything government does is ever for your benefit. It's not. And it also means that government is paying back debt that it may have borrowed, let's say, back here at 110, 115, 120, and it's paying it back debt at 87. So, you know, they've just managed to steal 40% of the debt, or not have to pay cash to retire at the currency fluctuations done that. So next time you hear the US complaining about currency manipulators, make sure you fall over laughing, because the US really taught them how to do it. Very, very effective from a government point of view. So we look at this chart, we say, okay, well, we've got to the top a little bit above the trading channel that it's been in since 2008. It's found the black line at 87.77. If it breaches that, there's a Danielcode 4 seal line not far above it, and I suspect we'll get a little bit of a break here, and then this market will probably wind its way back to the median, which is down around about 81.60. There's no real impetus. I know a couple of you have written to me saying that there's some comment around the markets that the DX is overbought. Well, not on these charts. It's not. It's a pathetic remnant of its once mighty self. Still, you know, better than anything else around, I suppose. But there is the trend chart. That's the 24-day chart, which doesn't lie. And all of this from this high here down this existing range is your purchasing power that has been lost due to inflation, price inflation. Okay, so let's move on, have a look at the 12-day chart now. DX, you have so much fun with these things. They do take a while to get through. I hope you enjoy them as much as I enjoy doing them. There's always a great deal to be learned. Here's our 12-day chart of the DX. Same sort of comment. It's broken through this red line very decisively here. So we can take that off. It's gone, and this is actually a fifth seal line up above it. Same thing, you've got the black line holding it, black line on a 12-day chart, 24-day chart. It's very, very powerful. And if it does break it, I suspect it will hit its head on this fifth seal line and turn around and continue its pattern of consolidation. Let's move on to the 6-day chart, which will be our final look at DX. And here it is. Same thing. You've got a 59. Don't forget these cycles here can go on the close. They can start at the closing low or the chart low. This one starts at the chart low, and it's been expired by 1 week. So that's why we have allowable variance of plus or minus 1 week. So that 59 cycle you see, which expired October the 30th, can still be working on this next bar, which expired already on November the 7th. So you've got a conjunction of fourth and fifth seal lines up here. If this 59 cycle doesn't turn this market back together with the black line at 87.77, then it'll probably work its way up into this conjunction here, which is going to be very early in the new year. And the probabilities are that'll send it back into its consolidation pattern. Okay, so that's how you do it, guys. So we've had a look at DX and gold and equities. I wanted to give you a really quick look just to give you some perspective on what some of these major agricultural markets are doing, which is pretty interesting. Here's coffee. We all drink coffee, or most of us do. You can see this market had an enormous run up from 2001 into the 2010 highs, a pullback, and from that low it's just bounced straight back up to the Danielcode red line retracement at 224, which is the 59 retracement. 59 is the dominant number in all of the Danielcode numbers, and that actually tells you that the downtrend remains in force. So we could see a consolidation through here, or we could see a return to a more pronounced downturn in that market. Soybeans is having a lot to say about itself lately, and here's our soybeans chart, which is we looked at recently. That's why it's got some fourth and fifth seal lines on it. When we last looked at it, I think we were looking at this line here for support. Well, it found it a couple of times. It broke through it. It fell to the next line, did a nice strong key reversal there, and it's now rallied up into the first of the Danielcode retracements, which is at 1092. Essentially, this market's in a downtrend. No particular vigor to it, but I would expect it to run into these lows from way back in 2009 in the not too distant future. As you can see, this line, firstly a line that's given support, will allow it to get down here as time moves on, but that'll give you a picture of where soybeans is. We wanted to have a quick look at corn, which is a market we don't look at often enough. And you can see this is in a very dramatic rundown inside a standard Danielcode trading cycle, and it's a strong downtrend at the moment. The rally has only taken it to the one standard deviation above mean. Probabilities are a false break of that, and a return at least to the mean. And the other one I want to show you, we've looked at coffee, we've looked at soybeans, wheat. See how our grain farmers are feeling about wheat, and it's sort of mimicking corn a bit, isn't it? This is the great days back in 2008. This was pretty depressing for growers. In 2010, we've had a sustained rally. Essentially, this market has range traded all that time. There are various support mechanisms for these important grains, which do tend to keep them within. I mean, we're looking at very large ranges here. Don't forget, we're looking at 24-day charts. But same sort of thing. It's rallied off the lower part of the Danielcode trading channel. Expected to go a bit higher until it finds its number in about here, 567.2 or thereabouts. At which stage the odds are it will return at least to its median. Okay, so that's that, folks. I think I've told you everything I wanted to tell you for the moment. And let me see the questions, see what we've got to talk about here. Can we take a look at copper for when? Okay, let's have a look at copper. Let's have a look at copper here for when. HG. Okay, there's copper. I don't know particularly what you'd like to know when. I haven't prepared anything for you. Incidentally, if there's any markets you particularly want to know about, shoot me an email, folks. Excuse me, I'll just show you the email. Should be on the ES chart the last time I saw it. Here it is, jneedham at thedanielcode.com. If there's any market that you'd like analyzed or you want to know something about it, if you shoot me an email a few days before any of these scheduled webinars, that'll give me some time to prepare the charts, or at least to make sure I have the charts on the right computers. I run 5 computers with various programs on each, and it's a question of pulling together the parts of the charts I want to show you. So always feel free to shoot me an email or just post in forum what you'd like to know about. So anyway, here's this market. This is a daily chart. We had a sell signal today, which was nice and profitable. Let's have a look at it on the 6-day chart. Copper, to some extent, has a relationship with gold, as I'm sure you would know when. So here's the longer-term chart on copper. Well, we've got a bottom. Let's use our little Danielcode tool to see how far this, here we are. We'll use this swing first of all. Not bad, was it? The 6-day chart, 330.05 was a 74% retracement. And we just do this, get rid of the ones we don't want that it's already gone through. We did want the 59, and we now want the 89. This is what this chart is doing, and we've now got support at, let's have a look again, same deal. Let's put the other side of the retracement tool on it. Let's take it from the swing high to the swing low, and you can find here that our decrease has been a little more pronounced. We're down to the 74 line, and all we'd have left for support underneath that is 89, the black line, the famous black line. So this market is had a rally, just got to the 74%. That's a very good rally. That probably gave us some hope the trend was changing, but this pullback now has told us that it's equally weak and equally strong. It's just breached the 74 on the downside and got to the 74 on the upside. So probability here is that excuse me, you get a continuation of this sideways movement. And don't forget, this is related to gold to an extent. Copper's a byproduct of gold mining in many cases. And I think best bet there when is a little bit more consolidation before it tells us something clearly. Okay, who else have we got here that had questions? Ben, my friend, where's the black line as part of the overall blue line strategy? 6-day bars, all global. Oh, this is Richard. Is the 6-day bars, stage bars, just pit session or Globex, and where are the starting points and ending points determine start and ending of bars? You're talking, I guess they are, they're the combined sessions, Richard. In fact, for your analysis, it's best to use the 067 contract, which are the continuous contracts from Trade Navigator. The starting points and ending points to determine start and ending of bar. I'm not quite sure what you mean there, Richard. Drop me a line, would you, and I'll be able to show you a bit more of that. Brian, bean oil, same thing next time, mate. We've just about run out of time. Would you shoot me an email? I'll be happy to look at bean oil for you. Crude oil market, Tony D. Hello, mate. How are we? Aussie USD for DPAC, natural gas. We've had a quick look at that, Richard. US bonds, very interesting. Stu for bonds. Smeds, hello, Shift. 35 degrees C, 35 degrees C at Shift's holiday home today on the north coast above Sydney. Right. You blew me off for the group for a topless 20-something, so you should. Wish I was with you, mate. Terrific. Don't get yourself too hot down there. Have a coldie, that'll cool you down. Okay, we're going to have a quick look at T-bonds and these other ones that I haven't answered, Richard and Brian and Tony. And also DPAC, and Richard, again, if you want more on natural gas. I'm not ignoring you. It's just that an hour has passed and I don't have anything specifically prepared for you for those markets. If you'd shoot me a line, just drop me an email saying you'd like to have a look at those. I can get some of the proper analytical charts with time cycles and fourth and fifth seal lines up for you for the next webinar. And I'd be happy to do that. Let's have a look at this T-bonds, which is been pretty interesting. Here's our 6-day chart. Let's go back and have a look at our 24-day chart. I actually have a very, very fascinating T-bond chart on the other computer. And basically, you'd start your analysis always with putting a Danielcode trading channel on the chart. You can either start from the low bar or the closing low before, it doesn't really matter. But those of you who don't know how to do this, there is a webinar called DC Trading Channels, which shows you exactly how to do it. Main thing is you need to have contact with one of these early points and then at least one other point. So this is a valid Danielcode trading channel you're looking at. People think the markets are random. They're not. This market has been running within that channel pretty much since August 1999. So it's been happily sitting there for 15 years. To this we can now add, this only has one channel running on it. We can add a second channel. We now have 2 channels, and you can see how the 2 channels contain this market pretty well. A break below the 1, it hasn't got anywhere near 2 channels down, but it has up here. It's challenged this upper line here quite severely, and this is all bullish. That means all prices going up all the time. Every pullback is met by continuing advance. And that's interesting because T-bonds are price on these markets going up means interest rates are going down. What T-bonds charts is actually the inverse of the interest ratio. So despite the daily drum beating about policy easing and loose settings from the Fed and everything else, nothing could be further from the truth. I mean, it's true, but the fact that it's something new or exciting is absolutely wrong. This started in 2000, and nothing has changed. In fact, this we could change this to a different setting. This is running on 1.59, which is the Danielcode number for equities. Gold has a slightly different number. This has a different number. If we set it on its right number, we'd be very close. We can probably get an idea if we change this chart to a close only. You can see that this bottom line, this 1 standard deviation from the mean, has only been breached on the close once since 2000. So you can see where the support is. Now that's institutional support, that's US Fed support and US Treasury support. None of this sort of level of precision happens by accident, but if you have the right charting techniques, you can see what they're actually doing as opposed to what they say they're doing. Is there going to be any change here? Well, it has reached a stage where if it was going to make a change at all, this is where it would happen. At the median, it's rallied up from 1 standard deviation off the mean into the median. It will try and hold that median, but if it's going to fail, that's the most common place. I don't think it's going to fail. This is a policy that's been in place now for 15 years. I don't think there's anything sufficient to change it. I think we're actually going to be in a systemic era, I should say. Let's move the E and the R around. A systemic era of ultra low interest rates. And it's taken a lot of time and a lot of money to engineer this chart to hold that upward slope so perfectly. And I don't think anyone's going to give it away right now. Okay, so folks, thank you. Let me see if there's anything I can do quickly here where I don't have charts for you. What have we got from Ben Sage? Had any more insights on her platinum or palladium charts? I don't know, Ben. I think she's probably trading platinum. I know that PA3, we're trading it on FracZen Pro, and it's sensational. I know you're trying to avoid technology, but you should get back into it, mate. It's a really, really easy way of making money, and I'll have more to tell you about that next week. So, folks, thanks again for your attendance here today. And Veroni, are you back in town, darling? I thought you were dancing the light fantastic up in the Alps in Europe or somewhere, but it's good to know you're back. Folks, thanks for your attendance today. That wraps us up for the day. I usually go a little bit longer, but I have another appointment, so you'll have to excuse me. And unfortunately, it's not sitting by the pool drinking Bloody Marys, nor is it being down at Max Beach with Shift, drinking cold beers and looking at the lovelies as they walk past. Do excuse me. Anyway, that's great. Shoot me an email if there's anything I can do to help you. Do give me a bit of notice on any charts you want analyzed, just to make sure I've got the right ones to show you. And hello, Marcel. Nice to see you, my friend. I hope you're feeling really great. Must be getting pretty cold up there where you are, because it's getting pretty hot down here, I can tell you. Okay. I'll see you in 2 weeks for a webinar, folks. And if there's anything particular you'd like me to focus on, please send me an email. There's lots of things happening in markets that are not particularly on my radar, but they may be on yours, and I'm here to give you some insight into any of those markets that I can. So thank you for your attendance. Enjoy your weekend. It's Friday morning here. One more trading session to end the week, and then enjoy the weekend. I'll look forward to talking to you all shortly. Bye-bye.